someone said recently with an SMSF, shouldn't you be all over it all the time? No, you shouldn't actually. You should set your sails basically, have the diversification right, have the principles right, and then let it do its own work. Over trading inside an ETF is going to be costly for anybody, regardless of the market. That's the thing. Not quite set and forget, but set and then monitor regularly. I think maybe 10 to 15 stocks is enough.
Welcome to the Wealth Masterclass from The Australian. I'm Julie-Anne Sprague, Wealth Editor, and we want to unpack self-managed super funds today. We want to tell you everything you need to know if you've ever thought about setting one up. We'll help you understand all the tips, tricks and traps. Joining me is James Kirby from our wealth team. James, thanks very much for joining us.
Hi, Julie-Anne.
Let's start first with how much money you need to have before setting up an SMSF.
This is $1 million question, how much should you have? And there's a big debate about it. Basically, people who inside the industry say you can start very low. By low, I mean 200,000 or so. I've had advisors very seriously tell me you need $1 million. I don't think so. I think something in the order of $300,000 is enough that the fees you will pay are justified.
I was going to ask that. So if you've got less than that, but you think, I want control over this, I want to do my own super, are you sort of shooting yourself in the foot?
Well, you want to be doing really, really well to justify the fees you pay. That's the thing, because if it was 3 million, your fees wouldn't be very different.
What are the advantages of having a self-managed super fund?
Well, the big advantage is you have control. If you're an active investor, you're probably pretty sure of what you're doing. Some people are very interested in particular types of investing because they really know it. They've been property investors and they know property and they want to put that into their self-managed super fund. So there is that aspect of control, and also there's just speed. You can do things quickly. You don't have to wait for the big lumbering $1 billion manager to get their act together. You can do it.
I mean, how long are they really taking, James?
It depends. You just don't know because you don't see you don't actually see how they've moved until well after the event.
Okay, so an advantage is speed, and you get to be in control. But knowing that means you're doing an awful lot of the heavy lifting. How much time do you realistically have to invest to make sure your self-managed super fund is in good shape?
Another item of debate, again inside the industry, people who want you to start a self-managed super fund say don't take much time. People who don't want you to, which would be big funds, they say that it takes an awful long time each month. I think it takes something between 4 and 8 hours a month. Some of the surveys say 8 hours. It depends on the type of fund you have. If you've got a complicated fund, it's going to take longer. If you've got a really simple fund, ETFs, all up, passive investing, an hour a week at most.
How much time do you spend, James?
Most of my time I spent filling out forms. The investing part I find no problem. The investing part is actually very rewarding, and especially when you've had a good year like we've had last year, the year before. You can't expect that every year. But the part that's actually a pain for self-managed super funds is literally documentation and having to fill out so many forms and paperwork. If you're not up for that, that might actually not be for you.
Get someone else to do the heavy lifting
someone else
for
to do
you.
it.
What about the construction of an SMSF?
Yeah, there's not as much about that as there should be. Like, there isn't an awful lot of education about that really, except that you're supposed to be diversified. In your fund, basically you'll have some guidance as to what it should have, but very generally you should diversify. That's become much easier in recent times than it used to be because you can buy exchange traded funds, and that allows you to really diversify, not just in Australia but all around the world. So you would very, very broadly have something like, you would make sure that it's dominated by active investments, risk investments, share investments, and then you have more fixed investments on the other side, like property, for instance.
Well, you mentioned that a lot of people set these up because they're big property investors, so they want to be able to put those assets into a tax-friendly vehicle. You put it into your SMSF, but it can be skewed too heavily towards property? Is that a mistake some people make?
Absolutely, it's a mistake that people make. Funnily enough, there's an awful lot of documentation, as I say, and it seems at times that there's a lot of red tape. At the same time, there's very loose rules about how you can have your super fund and how much you should have in it. Whether, for instance, 90% of it was one building. That happens now and again. We see this all the time in tax returns. And obviously that's not ideal. So you have to diversify. And if you're thinking of starting a super fund and the biggest single thing in it is one property, that's probably not the best idea.
Okay. What are some of the traps?
Well, one of the traps definitely is taking your eye off the ball, right? So you get it, you started, it's going pretty well, you did a lot of work at the start.
It's like when you join a gym, you know,
Exactly.
you're full of enthusiasm, we're going to do this, you're there every day. And
The
then
January gymmer, you know, you go back in March and they're gone. Something very similar with SMSFs. You need to be disciplined, and you need to be as the enthusiasm needs to continue, including on bad years. And it's harder, of course, to be enthusiastic about super on the year it goes down, especially if it's your fault. And it is your fault if you're running it.
James, is there an ideal age to set up an SMSF?
Yeah, I'd say, you know, within reason, maybe from 30 onwards. I mean, most people don't have 300,000 in their super at 30, but you can have less than that if you are, you know, if you are active and you know you're going to be committed to it, you're going to do it your whole life. So age doesn't really matter. I mean, education matters, and ability matters, and your sense of confidence around investing in markets matters. Probably over 30, and there's a point at which there's definitely a point, the statistics show, where self-managed super funds do become too difficult for investors who are quite old, and they actually can hand them back into big super if they get too much for them.
If you've got your current superannuation account, so most people have got their superannuation account, and then you'll be thinking about, I wonder if I can do this myself. Actually, I know I can do this myself. I want to do a self-managed super fund. How easy is that leap, and what do people need to know about transferring?
It's not difficult. I mean, big funds don't necessarily, rush to hand over the money because they don't like losing members to self-managed super funds. But it's quite simple. You do need an accountant. You don't necessarily need an advisor. If you have an advisor, of course, you could pay more, and you'll have a better portfolio. You would hope, but you do need an accountant.
So what are the lessons then? There's a bad year. I mean, we've had 3 really good years. It's been good for investors.
Yeah.
But when it's not going so well, are there some traps lurking there because you are in control? So you can make knee-jerk reactions or do things with emotion that perhaps an asset manager wouldn't be doing.
Absolutely. I mean, someone said recently with an SMSF, shouldn't you be all over it all the time? No, you shouldn't actually. You should set your sails basically, have the diversification right, have the principles right, and then let it do its own work. Over trading inside an ETF is going to be costly for anybody, regardless of the market. That's the thing. Not quite set and forget, but set and then monitor regularly. I think maybe 10 to 15 stocks is enough. Okay. Most surveys show that.
When you say monitor regularly, what are we talking about?
Well, certainly if you had one and I asked you 2 or 3 questions about how much certain investments are going, I'd like to think you'd be able to tell me if we were just standing on the street. So if you have 10 stocks, you probably can manage that. If you have 40 stocks, you can't remember them all. It gets too complicated. Okay,
so the tip here is to streamline it. Don't have too much in there, but you still want to have diversification.
Diversification from the start. It's quite easy with exchange traded funds now. It used to be quite difficult. Once you build up some momentum in the fund, then you can start to experiment and do things that perhaps that's the reason you started the SMSF. But begin carefully and let it build and watch and basically learn each year. As time goes by, ups and downs in markets, you do really get really valuable experience.
You talk to a lot of advisors, people in the market. Is there a common theme? Is there a common mistake most people are making when it comes to an SMSF?
Yeah, the common mistake is overtrading. Common mistake is just trying too hard, and reacting too quickly. Have faith in what you've actually picked. Have faith in the principles you follow, and let it take its course.
No matter what happens in the market.
Stick with it. Stick with your principles. And the worst thing possible is obviously to be overreactive, to be someone who sells, at the bottom, buys at the top. If you are a regular, constant investor that's disciplined, that won't happen to you.
You see this time and time again. There's volatility in the markets. People are panicking, and it's very easy to say, I need to protect my investments. So we'll just cash out, move to the side, and we'll come back in.
That's right. That's a big problem. It's very easy to cash out. It's really hard to go back in. It's the easiest thing in the world to cash out. The question is, when do you go back? And 9 times out of 10 people go back too late and they've missed the lift. And if you miss the big days on markets, it can really affect your portfolio long term. There are certain days every year, and if you miss them, or periods, 48 hours, if you miss them, you can really pay for it. So that's why this whole thing about not to set and be consistent and constant as an investor.
Okay, my final one though is you mentioned diversification. You might want to mix your portfolio around. So you've invested in a particular area, maybe it's a particular stock, but you think I'm too weighted in mining or retailers or the banks. I need to shift this. Is that then sitting down and doing the homework where you go, okay, I can reduce my holding in one thing, move to the other, but you're making this educated decision. You don't rely on what the markets are doing that day.
Yeah.
Do you pay attention? Do you sit there and wait for a PE multiple to improve? If you've kept your eye on Commonwealth Bank, for instance, and you're thinking, I'm not going to buy that at these record prices, and it just keeps going up.
Yeah, well, look, most people have a pie chart basically of allocation, and you might have shares, and that might be 60% of your portfolio, and maybe something like 30%, 40% of them should be offshore these days, and the rest on the ASX. And then the other part of the portfolio is fixed income and steady income, which is much more reliable. And then you look at your allocation, and if there's a bad day, if there's a scary day, and there will be several times a year, but you just review and say, is it set now for what I think is ahead? Is this appropriate? And basically, it's only small variations on allocations can make the difference long term. The main thing is to get the actual allocation right, the balance between shares, risk investments and less risky investments, growth and income, onshore and offshore. Once you get them right, I think that it's only very small variations in returns.
I'll let you know when I've got $300,000 and you can
Give me
allocate
a ring.
away. Thank you very much. Thanks, James.
Thank you.